Hello and welcome to our latest global supply chain think tank panel. And this one is called Cash and Uncertainty, Navigating the Supply Chain Landscape. So what this is about is people have picked up on the fact that corporates seem to be holding cash or hoarding cash, or however you want to call it, in order ostensibly to build resilience in the face of uncertainty in the global economy, geopolitics, tariffs, and so on. So we want to talk about whether that's real, whether it's happening, why it's happening, why they're doing it, and the pros and cons of it. So that's the general theme. I'm Patrick Daly of LMA Consulting here in Dublin in Ireland, and I'm joined by Lisa Anderson, who is president of LMA Consulting in the greater Los Angeles area in California, USA. Elizabeth Warren, who is president of Dialed In Partners, also in California in San Pedro, and Art Cook, who is, I think, still in Miami, Florida. And he is the founder and president of Arthur Cook Management Consulting. So welcome to you all. Did I get that right, Art?
Pardon?
Did I get it right? You're still in Miami?
I'm in Miami this week.
Okay, great. So a few of the topics we're going to explore. So first one is probably this corporate cash reflex. This idea of uncertainty as a feature now, not a bug. Maybe touch on the tariffs, trade wars, and flashpoints. Talk about holding cash or building cash as opposed to investing in capabilities. Maybe touch on also AI, productivity, and how that is affecting people and skills and so on. And some of the sectoral and regional contrasts that we're seeing around the place. So maybe to kick off, what's happening? So many multinationals seem to be cutting budgets and building cash buffers to stay flexible. So I guess the positive angle on that is that it builds optionality, and it might help them in the future if they have to do relocations or tariff payments and hedging for that and so on, M&A and digital investment. But there may be a negative side to it as well. So Lisa, US context, what are we seeing there? Does this resonate with your experience in the US?
We definitely, companies are looking at reducing inventory to free up cash. In essence, I think there's several reasons. It's to keep their financial results intact, is to make sure that they have money to invest, because after all, the interest rates are so high right now, and they've been high for a while. So it absorbs a lot more money, having to pay the higher interest rates, so that they're looking to make sure that they can put their money to good use, so that they can continue to grow the business, and that they also have cash for uncertain times, and also to free up debt levels. So really there's a lot of reasons, but the companies that across the board seem to be right sizing their inventory, so that they have they have no more cash than is necessary to be successful.
Okay, so it would seem then that they're trying to build a kind of financial resilience by having cash on hand to be able to react to things that may occur that are unforeseen. Is that it?
Yes, exactly.
And then Art, so you spend a lot of time helping people with their inventory. So are you seeing this as well? And is it feeding into inventory policies in manufacturers around the place?
Absolutely. Just the uncertainty earlier in the year, people started pulling back and, focusing on their inventory levels, getting that buffer or that cushion in case the economy went sideways. What I'm seeing now is that money being reinvested. One of the companies that I help went out and buying capital equipment. They reduced their inventory several $1 million, and they're putting that money to work buying capital equipment and working to get ahead of the curve of their competition.
Yeah, it's interesting because on the one hand, if you create financial resilience and you've got a whole pile of cash on hand, you've extracted that maybe from inventory, or maybe you've canceled some CapEx investments. And I'm seeing it, for example, in warehouse operations where they're reducing headcount as well as reducing inventories and so on. So while they're creating the financial resilience, they're creating an operational fragility on the other hand. So if an unexpected occurrence comes to pass, they may operationally, functionally not be able to react. And it's not going to matter how much cash they have on hand, because the systems are going to be breaking down. Do you see that as a risk, Art?
When you plan it right, you have the resilience. You have to build the partnerships back into the supply chain with your suppliers and your supplier partners, to where you have capacity reserved, parts reserved. And if you do it properly, you can be resilient. With what I've seen recently with this CapEx program, what happened was they carved out quite a bit of inventory. And by carving out the inventory, I'd been talking to them for years. They need to carve out inventory and free up floor space. Once they carved it out, they saw the floor space they freed up, they go, we can lay out the factory the way we need the factory laid out. And by laying it out, they looked at greater efficiencies. Then at the same time, going back to your early question, Patrick, they've been able to build partnerships with suppliers. Instead of doing a spot buy and buying things individually as they needed it, they put in long-term agreements, worked on partnership agreements, and now they're longer lead time items. They still have a long lead time if there's a significant swing, but they have things, what I call kind of marshaled in, going back into the supply chain to where they're more resilient to changes that occur. So they're very flexible at this moment.
Okay, it's interesting that this kind of crisis made them do what they probably should have done anyway some time ago, right?
Yeah, we joke that you have to create a burning platform or purposely break something to get somebody's attention. And crisis, I like to say, never waste a crisis. And once this, so-called crisis occurred, there really wasn't a crisis, but people thought there was a crisis, and they turned it into positive. And I have another client that's struggling through this. You see a glimmer of great success, and you see another one where they're floundering along. So, it's how business is.
Okay. And Elizabeth, you spend a lot of time looking at ports and freight movements. How is this showing up in your world? Well, I know there have been kind of surges and troughs in volumes going through US ports and the West Coast, for example. So how is it showing up in your world?
Well, thank you, Patrick. I appreciate the opportunity to be with everybody this morning. From a policy standpoint at the ports, when there's no cargo flow, there's no production, you've got disruptions that have this ripple effect across the entire supply chain with cash flow, delivery, planning, etc. And everything starts at the ports in the US. As far as once you get that manufacturing and it moves to the ports, then it goes through that supply chain. So when you have inventory tied up in transit, your cash is tied up. You've got dwell times at the ports, you've got congestion, all kinds of fees impacting your bottom line. So, really managing that, I think, is key. And so I agree with what Lisa and Art have said, just adding on to that. But regarding the cargo volumes, they've been up and down, like you said. They're manufacturers are trying to take advantage of beneficial cargo owners, those who are paying for that cargo to come through the ports. They are trying to take advantage of those tariff the lack of tariffs. I was gonna say tariff free,
Yeah.
but they're trying to take
getting in
advantage of
ahead of the tariffs. Yeah.
Yeah, getting ahead of it, and trying to front load and get ready for we've got, the holiday season coming up. So typically July, August are boom times anyway, because we're getting ready for the holidays. So you've got a double. You've got a double impact there. You're getting ready for the holidays and to stock up, but also you want to get ahead of all those tariffs.
Yeah. So it's interesting to see that what you were saying there, Art, requires a kind of a more nuanced and kind of complex or kind of strategic approach to managing the supply chain. So in the old days, kind of lean and cost cut and cut everything to the bone, it's kind of easy and straightforward. And now you kind of need to be doing that in some areas, but not in other areas. So that's a bit more complex to communicate, to manage, and so on. Is that a real challenge that you see?
I work with people and I try to get them to understand that you're always should be improving your inventory velocity. At the same time, I explain to them that there's typically a handful of parts that you have to stock and hold inventory. I'll go back 30 or 40 years ago, early in my career. Sorry, I'm that old. But I had some EPROMs that I had to get from Japan. And if I remember right, part of the manufacturing process was Japan, part was in California, then it went back to Japan, then it came back to the United States. And the lead time on those things would be anywhere from 40 to 55 weeks. Those parts, I made sure I had 3 and 4 months supply on hand of those. But at the same time, my other parts, I spun the parts that I could. I had parts I turned every day. So we achieved very, very significant inventory turns. That lesson I take to my clients and I say, you have to think about your inventory like that. There's parts that you cannot do anything with that you have to stockpile, and there's other parts you have to think smarter about. And that's an important lesson. And when it resonates with people and it clicks in, they can be highly successful. When they ignore it and they try to so-called lean out critical parts, and when turbulent times happen, they can get in significant trouble. And then their whole initiative or their agenda of improved inventory turns kind of blows up, and marketing and sales says, see, I told you, you can't do it. And then it takes them another 5, 6, 7 years to regain confidence to go after it again. So hopefully that answered your question. But when they do it, they're doing it right. And it's like Elizabeth said, some parts, they're stocking up on, but other ones you can do smarter.
Yeah. Lisa, complexity of managing lean versus being resilient.
Well, I completely agree that there's strategic inventory that you need to plan for, and then there's other that you could just manage as you go. What I'd like to add to this is that it's the perfect opportunity to roll out a SIOP program, Sales Inventory Operations Planning, because really in today's world, you have to be ahead of changing customer conditions, and they are changing all of the time. So if you can get a better picture of your sales forecast and what's happening with your demand plan, you can resiliently change your supply, reallocate production, you can manage inventory more closely without impacting customer performance. And even with that, though, there's always going to be something that you want to have a strategic inventory stockpile of, if you will. Could be a critical raw material that you cannot, produce without. It really just requires using a bit of common sense. But nevertheless, I think SIOP is definitely a great way to navigate these volatile conditions and making sure that you're staying ahead of changing patterns.
Yeah, a lot depends as well on the industry you're in, the situation you're in. I was thinking about this from a warehousing point of view recently, and published an article on it. So, people looking at the warehousing, do they view it as a cost driver or do they view it as a resilience enabler? So if you're saying, national distribution of a food product, your retail customers are not going to pay for your resilience. So it's all about labor efficiency and picking rates and so on. So you've got to manage your warehouse operations for cost efficiency. On the other hand, if you're a manufacturer, say, of a medical device that is mission critical, patient critical, and so on, if you tried to do that and supply fails, the repercussions could be catastrophic for revenue, for reputation, and for patient outcomes and so on. So it very much depends on where you are in the business spectrum, where you are in the supply chain, the situation you find yourself in, and also even within the same organization. So say within that medical devices organization, some parts of their warehousing function, say global warehousing function, might need to be run on a lean efficiency basis, and other parts on a resilience basis. But that's a challenge. It's a challenge to manage, it's a challenge to communicate, challenge not to confuse people as to what your message is. So well, that's what I'm seeing in that regard. So we might seg into this idea of this uncertainty. So there's been a lot of uncertainty the first part of this year. And when I talk to corporates around the place as to what they're doing, so what are you doing? Say, for example, multinational manufacturer located in Ireland, are you guys going to shift production to the US because of what's going on? And what they say is, well, we're looking at it, but we're not taking any decisions because we want to wait for the fog to clear and then we'll see what we do. And then I'm thinking, the fog ain't clearing. So this idea of whether the uncertainty is a bug or a feature now, I'd like to get your viewpoints on that. And maybe I'll start with you, Elizabeth, this time. So you're seeing a lot of this turning up as volatility in the ports. So is that just the way it's going to be, or is this going to settle down sometime? What do you think?
Well, this has been something that's been going on for decades. We used to call it the four-corner strategy with the 4 ports. You didn't want to have all your cargo coming into one port, which used to be Southern California. Northeast, Southeast, and Northwest started building up their ports and try to taking cargo away. So now there's a lot of viable ports all over the US. So my advice to manufacturers that are shipping in is that you definitely want to treat the ports as part of your supply chain and transit. So you want to know the ports, you want to know your terminals at the different ports. You want to use that infrastructure investment. Look at those, follow those timelines, and then factor in, of course, what's happening in locally. So because the more visibility you're going to have at the front end of your supply chain, the better that you're going to be able to manage that inventory and your cash flow eventually downstream. So whether or not they should move manufacturing to the US, I'm going to leave that up to Art and Lisa to talk to them about that part of their supply chain. I can talk to them about what they do with it once they decide they're going to move that cargo. Then talk to me about where we're going to move it, how we're going to move it, and when you're going to get it out to your customers. But yeah.
Okay, well, Art, over to you then. So waiting for things to settle, is that just wishful thinking, and is uncertainty just the way it's going to be now?
I've heard multiple people talk about the fact that we're in uncertain times, and I call BS to them on it, because we've been in uncertain times since September 11th, and that's been close to 25 years ago. Everything that's happened since that day has been chaotic in the world. So during the pandemic, we talked about pivoting, and all of us got tired of people saying you have to pivot on things. Well, people have been pivoting for the past 25 years, and the best ones that are pivoting are the ones that are still in the marketplace, still growing and resilient. So, yes, I think it's not a bug, it's an attribute, and organizations have to be nimble. A thing that I see that's happening, and it's finally happening, and I've talked about it for almost my entire career. Lisa's smiling because she knows where I'm going to go with this because her and I talk about, you know, there's people have begun to rethink where their supply base is. And is it in countries that have the same political ideals as your country? Okay. That's happening now. And I think that's important to happen. There was this time where people thought if we use trade that we would create consumerism, people would see how the West is, and they would all of a sudden, the government would change, so on and so forth, and we'd come in alignment and we'd sing kumbaya and sail off into the horizon and everybody would be happy in the world. Well, people are people, and it doesn't happen that way. So now, geopolitically, there's a big alignment when it comes to powers and supply base and where things are manufactured. That being said, it's okay to be a global company. You know, you need to be a global company. You need to operate in these countries that maybe we are not the most friendly with, but don't have all of your parts being shipped from one of those into another economy. Build regional supply chains and support it from that area. And now people are starting to do that. Is it something that's going to happen overnight? No, because we spent 30 years building these global supply chains. And in order to build these regional supply chains, it's going to take 10, 15, 20 years to build it where it's resilient and cost effective. But with that, you'll optimize your inventory. Your inventory level will come down drastically. Since 1987, I think inventories in many businesses have went up as much as 70%. We're only starting to see that level out and come down with the regionalization. Sorry, I
Yeah.
took too long on that, but
Well,
that's my 2 cents.
it's interesting because say in the world before 1990, it was quite simple. There were two blocks and you were either in one or in the other, and supply chains were kind of separated by those blocks as well. I actually recorded a video recently in the East Side Gallery in Berlin, beside the Berlin Wall, where they have all the pictures painted on the wall. The famous kissing photo with Brezhnev and Honecker. And in the video, I was kind of talking about how that symbol of division, it didn't only divide politics, it divided supply chain. So, you know, where stuff moved and so on. Then we had globalization, so everything opened up and people are investing in China, and even in Russia in the 1990s, people were investing there. And now we have this new world, and it's not one and it's not the other. It's kind of, it's a mixed bag. So today you have Modi in Shanghai holding hands with President Putin. And then recently, just before Trump came in, he was in the US with Biden making sweet there. So, you know, India is a big country that's playing a game that suits its own interest. And other countries like Brazil or Turkey, which is supposed to be an ally in NATO, they're plowing their own furrow as well. So I think it's going to become a lot more complex like that, as you see, as you said, and you'll have some things in those countries, but maybe not the most sensitive things in those countries. So we're in a world that is neither the one before 1990 and definitely not the one from 1990 to say September 11 or the financial crash in 2008. And it's a very, very much more complex and difficult to negotiate and hard to understand world that we're in now. So Lisa, I know you've been thinking a lot about interest rates. I know you and I spoke about interest rates. We spoke about tariffs, and we spoke about tax, and what's it called, the big beautiful bill or something
That's
that it's
right.
called, which kind of prolong those kind of tax cuts into the future. So how do you see those three things, tariffs, tax, and interest rates, playing into what we've been talking about today?
Well, what I'm seeing is that as it relates to the uncertainty, I agree with Art. As I'm starting to see clients looking to invest again and move forward. There was some with the uncertainties that arose earlier this year. It really didn't impact their supply, but it impacted the volume. And so now, I start to see light. I'm starting to see light at the end of the tunnel. I think it's actually going to be a boom period for manufacturing. And it does relate back to the question, because I think there's three legs to the stool, and all three are coming into fruition. So the first is, as you said, is tax. It's also cost. So there's, with the tax bill that was recently passed, companies can count on a much more competitive rate carrying forward into the future, instead of going back up to a completely to a rate that would have definitely not been competitive. And so, they can count on their tax rate. They also have some expensing and write-offs that they can take. And in addition to that, there's a focus on deregulation and energy cost, which are huge in manufacturing. So basically that's a cost pillar, if you will. So they can count on lower costs going forward, if you will, in many respects. The second pillar was tariffs. At first, everyone wanted to know what was going on with tariffs. We're now at the point that enough as to where things are going with tariffs. If not, you can estimate it. And if you wait any longer, you're going to be left in the dust. So, folks know what's going on, and they need to, figure out where they want to put their supply chain, what's best for their company, and move forward. So the tariffs are largely resolved. In fact, we have open market access in a lot of cases. So there's opportunities coming from that. And then the third leg of the stool is the interest rates, because at least some of the larger capital intensive manufacturers have really been struggling because the interest rates are just so high. So their customers aren't able to buy these large pieces of equipment, or at least not in large quantities, if you will. And so as we move to the fall, it's looking increasingly likely that the interest rates are going to start to come down. And just last month in August, for the first time since COVID, we finally got to the point where we have worked through the money supply, because there was a bunch of money thrown into the marketplace, if you will, to try to get through COVID, but it caused inflation, and it's been a real issue. So we finally have worked through all that money supply. So now it's not only likely they're going to decrease interest rates, but it's like dictated from the economics of it. So anyway, as those three legs came into place, I see a large boom going to happen in manufacturing. In addition to the reason all these things were happening in the first place is the geopolitical issues that are going on throughout the world. And as Art said, or maybe it was you, Patrick, I'm not sure, but basically, we should be looking at regional supply chains, friendshoring. So meaning like we should be partnering with our friends that we can count on for critical supplies, defense, medical, pharmaceutical ingredients, like these aren't things you should count on people who you may or may not be able to rely upon. So, for a toy or something, of course, everybody wants their kids or grandkids to have a toy, but it's not going to be the end of the world if you don't have it. So maybe you'll put it in a lower labor cost country, who knows, but nevertheless, you're not going to be playing willy-nilly with critical items anymore.
Yeah, it's interesting that the regionalization of supply chains has been going on for quite a while. Now maybe it's accelerating or consolidating. And although the tariffs came in, there seem to be countervailing maybe productivity gains that are offsetting those tariffs. So maybe they're not going to have such a large inflation impact as people may have worried about. And it does look like interest rates are going to come down, not because of political pressure, but because of the economic conditions, as you said. Yeah. A couple maybe of clouds on the horizon there. One of the debt levels and the projected debt levels in the US, and the other one, which was in my mind and has just escaped me, but it'll occur to me again. So what do you think about that? Those building levels? Oh no, the other one was the fact that we see tariffs settling, but then we see, for reasons that seem not to have anything to do with economics, sometimes, say for example, what's happened with India recently, an extra 25% tariff, bringing it to 50. Yep. And maybe tariffs on Brazil because of some court case against Bolsonaro. So stuff like this. So those two things are kind of wild cards. The ballooning debt, which this new bill seems to want to make bigger, and this kind of wanton random application of tariffs for reasons that have nothing to do with supply chain or production or whatever. So what would be, all of you guys, what's your thoughts on that?
Patrick, can I say something about tariffs real quick?
Yeah.
One of the things that we needed to do with our clients is to educate them on the cost roll-up of tariffs. For example, we had several suppliers come through and say, okay, the tariff's 25%, and they just added 25% to the cost of their part. And the buyers that are not as savvy, oh, okay, that's what it is, and they took it. And I'm going, whoa, wait a minute. You have to remember that on top, they're paying a certain price, then they're adding on their overhead, their profits, their transportation, so on and so forth. So once you start peeling that away, in many cases, it's somewhere the increase was, instead of 25%, was down in the 10 or 11%, and it was easier to absorb. So that's something that the media doesn't talk about. Okay. Yeah. The media doesn't talk about it all. So that really had it wasn't as big of a gulp for people to swallow.
Yeah.
Okay. Yeah. I think that's something that's often missed. It's always missed in the discussions.
Yeah. Yeah.
Yeah.
Okay.
Well,
sorry.
Go ahead.
No, you go ahead, Lisa. But that question of the ballooning debt and
I got it. I was thinking, what was the
non-economic tariffs,
so,
if you want to call them that.
Got it. Okay, so I think that really the bill was tailored to growth in the economy. So for sure, it's going to add costs into the picture to, like, for example, get less income, if you're gonna, no taxes on overtime up to a certain amount, those types of things. However, it's really, it's going to it'll stimulate growth, which is part of the purpose of that. But it's also going to, what I'm seeing between that and the tariffs, I think that they're going to be offset, or even more than offset, possibly, by the reduction in energy prices, because energy is such a large contributor to manufacturing. I mean, well, obviously it is in goods movement too, in terms of transportation costs, but I don't know the percentage necessarily. But in manufacturing, in most of the manufacturing companies that we work with, it's a significant number. So that alone, and the second significant number is regulations. And, like, for example, like well, kind of combination of the two in California, like the cost of electricity is just crazy. So, you know, from that point of view, the more that that can be deregulated in a smart way, of course, and that can be taken out from a, you know, energy cost basis, and volume does cover all ills, if you will. So basically, as the volume, you know, really starts to increase, I don't necessarily see that being an issue. And I think what's happening most recently is that we're getting some record levels of tariffs, which is definitely it's gonna offset more than the tax bill at this point from the estimates. So I don't,
Yeah.
you know, I'm not saying that, you know, there's lots of things we could say about this, but just sticking to the numbers, I think is, you know, if anything, the goals are going to be to reduce the debt as we grow. So I think I don't think that that's a concern necessarily. Now,
You mean
these
reduce it as a proportion of GDP rather than in absolute terms, perhaps?
Correct. Exactly. So, you know, if we grow, you know, I think it's going to stimulate significant growth. There's over $8 trillion of investments that have already been announced. And, you know, there's also going to be, in addition to that, a boom in manufacturing for all the other reasons we've been talking about. And there's, like, for example, there's also, you know, a lot of investments going into shipbuilding, which relates back to Elizabeth, and, you know, some of these other areas that are also national security related areas, but they're going to stimulate manufacturing, and manufacturing stimulates the economy. For every dollar invested in manufacturing, $2.67 goes to the economy. And I think there's a similar statistic for AI, but I forgot the number. I'll have to memorize it. But it's something like, for every dollar invested in AI, I want to say it's between $3 and $4. It might be $4, but, you know, it's obviously the manufacturing statistic plus something.
Yeah, Art, did you want to say something? It looked like you were going to say something earlier.
No, I'm in alignment with Lisa. Is, you know, when you look, people often say that, you know, Trump's bill is laden with debt. It's not any more than what Biden did, what Trump did before, what Obama did, and Bush did. So the debt is the same level that's being added. And the model that I believe that he's trying to put in place is to get growth. And at the same time, if we get the growth, we will overcome adding any more to the debt. And that's, to me, in my viewpoint, the most critical thing at the end of the day is we have to start lowering how much debt we have and not add any more to it. And I think the key thing with the big, beautiful bill and Liberation Day is how it plays out over the next 3 years. And if it plays out the way it looks like it's playing out right now, that if we hold it steady for another 4 or 8 years, the growth in manufacturing, as Lisa's talking about, will be unprecedented.
So I guess, and what might play into that as well is what we've been talking about here at the beginning. So people are building up cash reserves to hedge against uncertainty. If they became more optimistic, as you seem to be saying they ought to be, then they have these cash reserves to do what they want with, to invest in capabilities. So would you be expecting then that, as like Art, you maybe have gotten to a place that where you're looking at this and you're saying, okay, this looks like it's a good picture into the future. Do you think more people will be coming to that conclusion and then saying, look, we got all this cash here, let's do some exciting things, AI or whatever it is?
Well, you see that in the tech industry, okay? And the United States tech industry has led the world, all right? And they build up cash and they go buy businesses. And when they buy businesses, recently, Who just bought one of the Chat GPT just bought another AI company, and the head of that AI company has become their CTO, the $1.1 billion stock deal. Okay. And we'll start to see that in manufacturing. I already saw it with one business. They freed up cash. They had to borrow some, but they cleaned up their balance sheet enough that the board and the investors said, hey, it's okay to borrow the rest. And they're investing in technology because they're looking at what they have to do to compete at that next level. I've already seen it in one business. And what they did, that business itself, it really used lean manufacturing a tremendous amount and improved their business. They improved their inventory velocity. And then they're looking, okay, we got to take the next swipe. They had cash, they need a little bit more, but they went after it. And I see more of that. It's a ripple effect. But we have to get leaders in America that understand this. Okay.
Yep.
Any leader needs to understand this, because so bloody often I've seen them chase the labor dollar and chase this ghost of cost. And we end up building more inventory and not investing in automation. And in order to compete in the world and have our standard of living that we have of, you take Western Europe and the United States, that standard of living, it has to be through automation. And you see what AI has the capability of with mechanical automation dovetailed. A highly technical term, Katie, bar the doors. It should be an exciting time.
So Elizabeth, in terms of companies building cash, now I know the big shipping companies, for different reasons, back in 2021 ended up building huge amount of cash piles because the rates had gone through the roof. So have they been doing the same thing? And if they have, how is that likely to play out in investment in ships or in port infrastructure? What are you seeing there?
I really don't work with the shipping lines on that level. So I wish I had an answer for you, but I apologize. I can't even speculate on that one.
Okay, so
I know some of them have been investing, Patrick.
Maybe Lisa can, yeah.
Yeah, I know some of them have been investing, some of the shipping lines, but I just actually did a supply chain bite on shipbuilding yesterday. The U.S. Federal government has dedicated $150 billion for shipbuilding, which they really need, because after all, it's quite horrifying. Like we built less than 3 ships last year, and China built 1,300, so it's quite crazy. But nevertheless, they dedicated 150 billion to it, and South Korea has committed to invest 150 billion into shipbuilding in the U.S. because they look to take advantage of the growth opportunity in the U.S. And of course, we put together a trade deal to partner with them because they have expertise in shipbuilding. But they started that with a small investment in the Philadelphia, well, small compared to 150 billion, but they started with an investment into the Philadelphia shipyards. And then, there's some private investment going on as well. So we've been talking about that early on, like Art said, technology, well, defense tech, like there's a firm called Sardonic, and they just built the fastest ship build since World War II, which is impressive because we need it, because after all, we have 3, and they're expecting to go to 50 a year rapidly, and that's just that one company. So anyway, my point is that, Elizabeth is right, and it's looking bright for getting closer to building ships in the US. I mean, we received them today, as Elizabeth well knows, but we're getting, we don't have to build all of our ships, but again, we need to be able to build ships.
Mm-hmm. Yeah, and I guess the wild card in all of this is productivity improvement, because you kind of touched on it, Art. In order to maintain or to grow a standard of living, you don't just have to increase output, you have to increase output per unit of input. So in other words, you have to increase productivity. And AI is holding out a lot of promise. And I think we've probably all witnessed it in our own day-to-day work where we have been experimenting with it. So, and Lisa, you and I had a conversation on this recently as well. So in terms of AI early adapters, Art, what kind of things are you seeing? What kind of promise does it hold? And does the speed of the productivity increase even become overwhelming in the sense that it might displace people,
Right.
or is it just going to compensate for the lack of people that's already there?
So I'm going to throw up a cautionary flare. Okay. MIT released a study about a month ago, and it said only 5% of AI pilot programs have shown profitability. Okay. I do not know. I read the 3-page article on it that they issued, so I don't know who they studied and the details behind it. And I don't know what that's compared to, the internet 25 years ago, if they did the same study with the internet. Is it early adopters, so on and so forth. But AI shows tremendous promise. And I honestly do not see AI being a false dawn. You know how we had blockchain? You know how everybody said blockchain was going to change the world, and I kept saying it has very narrow where it can work, and I didn't believe in it from the beginning, and I was right. Then the same thing with those of us that have been around long enough, MRP2, where they were going to automate the shop floor, and I'm saying you can't automate the shop floor unless you fix all the blueprints and all the data and all the data collection, et cetera, and they never did that. But I see a huge amount of promise in AI. Okay. I don't think it's a false dawn, and I think it's going to change the game. So, kind of backing up, the United States had been at what is called basically a zero unemployment rate for years. And that number means the people that want to work are working. Okay. And it's still like that today. Okay. The unemployment rate of, 3.25% is basically that zero unemployment rate. Okay. And if you add a percent onto that, 4% is maybe where you got 1% of the people that are out of work. So what I see AI doing is expanding to where we're going to be more profitable. We just have to make sure that it works. And I sit in another think tank, and I heard too many CEOs saying, oh, we're using AI and we're eliminating positions. And I just blew up. And I go, are you out of your blankety blank mind? You do not lay off anybody due to a technology improvement. You need that brain power to capture your competition and go after them. And as soon as you start laying off people, the people that are there are going to put the brakes on any improvement because they're going to think they're next to be laid off. Okay. So I tell you, the opportunity that's in front of us with, regionalizing, getting inventory out of the supply chain, improving our quality, using AI and hard robotics automation, it's there. And I think we're finally gonna capture what we needed to do started 20 years ago in the States.
Yeah. It opens up the possibility to address certain challenges and problems that were just unviable to tackle before.
Yes.
So Elizabeth, have there been at the port some pilot projects maybe that we've heard about with advanced technologies? Could you tell us a bit about that?
Yeah, both ports of LA and Long Beach are both working on their port optimizers. I forgot what the one at the Port of Long Beach is called, but the Port of Los Angeles has one called the Port Optimizer. And they've been working on that for years as a way to optimize the cargo coming in and moving it through the system faster. So they can see cargo out, a couple of weeks. It is proprietary. You do have to work with the port, sharing information, but they've really had some success with it. There are some other companies that are trying to do their own thing, but the Port of Los Angeles is really trying to get a lot more folks on board. Our local universities, Cal State Long Beach, and even the labor unions are all working on training and getting more workforce development. And certainly AI is going to be a part of that. I agree with Art. It's not going to go away. It's here. It's here to stay. It is going to be a game changer. The big concern at the ports is, will it replace jobs? And that is through with the labor and the longshoremen, is it going to replace jobs? But like Art said, I don't think it's going to replace jobs. I think it's going to enhance the jobs that you have. You've got to be able to, somebody has to be able to look at that data that you're going to get and then figure out how to use that data. So I think there's lots of ways that AI is going to be used. I read somewhere just within the last couple of weeks that AI is at the stage right now that the internet was 25 years ago. 25 years ago, we were all just hearing about the internet and we were all curious. What is it? How does it work? And now we use the internet all day, every day. And I think we're in the same stage with AI, and that in a few years, we're all going to be using AI in some way and not even thinking twice about it. And I know a lot of people now, including myself, we use AI instead of Google to look something up.
Yep.
Just put it in AI, in Chat GPT, and ask the question versus Google. So I'm on board with Art. Agree 100% with Art's comments about AI and where we're going with it. It's here to stay, and we're going to use it.
Yeah, maybe just to round out, Lisa, final question. So, any thoughts on why these pilot projects are failing, mostly failing, and with regard to AI adoption gaps? Is this likely to widen the divide between those companies that are building resilience through productivity and companies that are left brittle and getting left behind?
Yeah, I think that it's somewhat similar to, ERP has horrifying statistics as well. They say, oh, at least 80% of them fail to achieve the intended results, yet everybody has ERP. So it just depends on how you implement something. And if you're talking the big bang approach where you have to have everything perfect. So what I'm finding is that companies are being extremely successful with AI and delivering not just profit to the bottom line, but it's really going to help support growth, which we were just talking about. We're going to really need. It's not like we're going to get to be able to hire, 20% more people. They simply don't exist. And we're going to need to scale up operations rather dramatically here. So AI can help with those. It really is starting with a, sort of a common sense approach, a focused project. With, get a quick win, build on your momentum. So to some degree, it sounds very normal to us on this call because it's what we're used to doing. But a lot of companies don't do those kinds of things. They, you have to have a good leader, right? There's a lot of different common sense, to some degree, project management things, common sense technology items that you should be following, and you'll be wildly successful. I mean, if you try to transform your whole company today with AI, and that's your objective, yeah, you probably have a 5% success rate, because who does that? Start with something small and, do a series of projects that get you there rapidly, that fund itself. With ROI. So, I mean, it seems to me like the companies that are using some of these uncommon common sense techniques really are going to be very successful.
Yeah, so you can see that if you get started with a use case that is successful, delivers benefits, people learn, then they do more, then they do more, then they do more. But you can see the possibility or the risk of a gap opening between those who do that and those who are either they don't have the confidence, they don't have the capability, and they don't know where to turn. So you could see a big gap opening. Yeah.
You brought up my favorite topic, Patrick, because I've been saying for many years now that I think that it's going to be in the next decade, we're going to have more separation between the winners and the losers than any other time in history. And I still believe that's going to be true. And especially because of what you just said. I mean, sure, if you don't assign a good leader, if you do get rid of all of your good employees when you get AI to work, all of these things are going to lead to failure, and you are going to lose customers because you're also going to lose volume. You're not going to serve customers well. On the other hand, if you take a smart approach to it, you're going to be, very successful, and you'll probably be able to choose which customers that you serve, and you'll shoot to the top of your marketplace. So I think in the US, the only other time this has happened was during the Great Depression. And this will be, similar amounts of change with AI, but, more positive for sure than a Great Depression. But nevertheless, like the same outcome, because, there was more companies that shot to the top of their industry, and they stayed there for decades.
Okay, so I guess at the end of this conversation, well, I feel a little bit more optimistic than I did coming into it, to be honest. Notwithstanding the challenges, and there are real challenges out there, and I guess one of them is that risk of a gap opening up, because when gaps open up, you tend to get political issues associated with that as well, because you have winners and losers, and in this case, as you say, Lisa, maybe very big winners and very big losers. So that's going to be a challenge to manage. But there's a lot of positive in what you're seeing, both in terms of technology, in terms of the regionalization of supply chains, in terms of kind of rebalancing security of supply and so on. So that's my wrap. If any of you want to make a 30-second contribution at the end to wrap, go for it, and then we'll call it a day. Art?
Okay. One thing I forgot to bring up is more and more young adults are looking at trades. And with AI and automation, it's going to become more sexy, so to speak, to go into manufacturing. And the best and brightest, too many of them went to university and got great degrees, but didn't have great careers with them because they didn't pay well. And you take that brain power and you put it into automation, robotics, and AI working in a manufacturing, great careers, great livelihood, and great growth for those people that have been left behind with the university system.
Excellent. Elizabeth?
Thanks, Patrick. I think just be cautiously optimistic. There's investment, automation, decarbonization, collaboration across public and private sectors. But like we've been talking about for the past hour, geopolitical tensions, labor shifts, we might still get some surprises. So stay informed, be flexible, and that's when you'll be in the best position for growth.
And Lisa, finally.
I see that as these opportunities arise and companies start taking advantage of it, it is going to cause additional disruptions, because as supply chains evolve and move, there are going to be companies that just expect the history to repeat itself, and then that's not going to happen. So, I think it will stimulate, if you're forward thinking, innovative, and nimble, you'll have more opportunities than you can even account for. So there's lots of opportunity on the horizon.
Excellent. So let's leave it at that. So thanks to Lisa in Los Angeles, California. Thanks to Elizabeth, San Pedro, California. Thanks to Arthur in Miami, Florida, and goodbye from me in Dublin in Ireland.
Thank you,
Bye-bye.
Patrick. Thank you, Patrick.